Welcome to the C4 Direct Taxes Examination Technique presentation of the Zambia Institute of Chartered Accountants. My name is Jeff Tabanda, presenting. The Zambia Institute of Chartered Accountants has regrettably noted that the performance of most of its candidates for the various Zika accountancy programs has generally been below average. This performance has been attributed to many reasons, such as inadequate preparation for the examinations and also lack of examination technique. This being the case, Zika is presenting suggested examination techniques in the various subject areas, including C4 direct taxes, which is the subject of this presentation. After these presentations, it is hoped that future performance in the various subject areas will significantly be improved, so much so that students will be in a position to attain their qualifications in a record time. Now, this examination technique presentation is in the following three parts. One, approved C4 direct taxes syllabus and the general competencies which are required. Number two, the topics in which many students have exhibited lack of knowledge and difficult in attempting examination questions. Number three, the examination answering technique for the areas where most of the candidates of C4 direct taxes has exhibited lack of examination answering techniques, and selected practical questions for each area where most of the candidates have continuously demonstrated lack of knowledge and examination technique. And lastly, we'll be looking at the general examination answering technique. Now, the approved syllabus here on direct taxes, it looks at explaining the role and purpose of taxation in the economy, calculating capital allowances and taxable business profits for unincorporated businesses, computation of emoluments from employment and explaining the operations of the pay system, describing the various categories of investment income and calculating the tax payable on each of them, calculating the taxable business profits of companies and income tax thereon, and explaining the role of the Ministry of Finance and ZRA in tax administration. Now, when it comes to the role and purpose of taxation, this would include a couple of aspects such as the classification of taxes, taxable and exempt incomes, and so on. And when it comes to income tax of unincorporated businesses, these will be looking at trades, professions, vacations, computing taxable business profits, capital allowances, accounting dates and basis assessment, turnover tax, presumptive taxes, and so on. And when it comes to income tax and employment income, this will be looking at emoluments, which would include salaries, and other allowances, employment compared to self-employment, taxable and exempt emoluments, and the operation of the pay-as-you-earn system. Now, when it comes to income tax and investment income, this looks at the types of investments for individuals and companies, and then the withholding tax system, computation of taxable income from letting of property, and treatment of income from savings and financial investments. Now, when it comes to company income taxation, this basically looks at the residence of company for income tax purposes, computation of business profit for companies, treatment of investment income for companies, computing company income tax payable, turnover tax, and also the tax loss treatment. Now, when it comes to property transfer tax, this will be looking at meaning of transfer and realized value, transfers within group of companies, transfers to members of the immediate family, computation of property transfer tax and its payment. And when it comes to the administration of direct taxes, we're looking at the role of the Minister of Finance and also payment of income tax by individuals, and objections and appeals procedure, among other things. And now this takes us to exhibited difficult syllabus areas in C4 direct taxes. Now this takes us to the areas where most of the candidates of C4 direct taxes have had problems when it comes to exams. These will include basis periods, employment tax, capital allowances computation, and business profit computations. Now, when it comes to basis periods, candidates' difficulties have been in the following areas. They've not been able to realize what is the meaning of the basis period and the assessment rules. They have not been able to realize what current year basis, preceding year basis means, and they have not been able to realize and apply the commencement, cessation, and change of accounting date rules. Now, when it comes to basis periods, in relation to basis periods, kindly be reminded of the following. There is what is called a basis period and basis of assessment. Basis period simply means the accounting profits which are taxed in a particular tax year. And the basis of assessment are the rules that govern as to when some profits will be taxed. And these will be current year basis, preceding year basis, and so on. Now, when it comes to a basis period, as has been alluded to earlier, a basis period is an accounting period whose profits are to be assessed in a particular tax year. And the basis of assessment is a set of rules used to assess in which tax year profits will be assessed, which can either be on a current year basis or preceding year basis, as will be explained in the following discussions. And it is to be recalled that the tax year in Zambia runs from 1st January to 31st December each year, and businesses are encouraged to prepare their accounts from 1st January to 31st December each year, although they can prepare accounts to a date of their choice, which would affect the basis periods accordingly. Now, when you look at a basis period, it is better to look at a basis period deadline, which I'm looking at now. If your accounts end anywhere between 1st of January and 31st March, the basis that is used is the preceding year basis. And if your profits or your accounts end up anywhere between 1st of April and 31st December, the basis that is used is a current year basis. Now, we are saying the preceding year basis here simply means that the profits that are going to be taxed in the preceding year will be the ones for this year. And when it comes to the current year basis, it simply means that the profits which fall in this particular year are the ones that will be taxed in the same year. Now, when you look at current year basis, as I have said, current year basis means that the tax year in which accounting period ends is the tax year in which the resulting profits will be subjected to tax. And this applies to all accounting periods ending anywhere between 1st of April and 31st December. Refer to two examples which are going to be following. If we look at current year basis, practical example 1 here, I got a case of Company X, which has always prepared its financial statements to 31st December of each accounting year. And during the year ended 31st December 2019, its taxable profits amounted to 180,000. Now, our observations here are that these profits fall in the tax year 2019. And because the end of the tax year is between 1st April and the 31st December, the current year basis will apply, meaning that the 180,000 kwacha will be charged to tax in 2019 tax year. My second example here looks again at Company X, which has always prepared its financial statements to 31st July of each accounting year. And during year ended 31st July 2019, its taxable profits amounted to 180,000. And we observe here that these profits fall in the tax year 2019. And because the end of the tax year is between 1st April and 31st December, this time around, the current year basis will apply, and hence the 180,000 will be charged to tax in 2019. Now, when you go to preceding year basis now, preceding year basis means that the preceding tax year in which the accounting period ends is the tax year in which resulting profits will be subjected to tax. Let me just explain a little bit here. What it means is that if you got profits which fall in 2020 using the preceding year basis, it means there will be tax in 2019, which is the preceding year. And this applies to all accounting periods ending anywhere between 1st January and 31st March. And the following example 1 is on record. Company X has always prepared its financial statements to 31st January of each accounting year. And during the year ended 31st January 2019, its taxable profits amounted to 180,000. Our observation here is that these profits clearly fall in the tax year 2019. And because the end of the tax year is between 1st January and 31st March, the preceding year basis will apply, hence the 180,000 will be charged to tax in 2018. That's what a preceding year basis is. Now, my example 2 of the preceding year basis, again, is about Company X, which has always prepared its financial statement to 31st March of each accounting year. And during the year ended 31st March 2019, its taxable profits amounted to 180,000. Now, we observe here that these profits fall in the tax year 2019. And because the end of the tax year of this company is between 1st January and 31st March, the preceding year basis will apply, and hence the 180,000 kwacha will be charged to tax in tax year 2018. Now, this takes us to commencement rules. The rules here are that the first accounting period, if the first accounting period is of 12 months or less, either the current year basis or preceding year basis will apply accordingly. This would depend whether you are looking at accounting periods ending between 1st of January and 31st March, which will lead you to preceding year basis, or those ending between 1st of April and 31st December, which will lead you to a current year basis. If the first accounting period is made up of more than 12 months, such an accounting period is split into 2 periods. The first period having less than 12 months, and the second one having exactly 12 months, which will be assessed on either a current year basis or a preceding year basis accordingly. An example relating to the commencement rules here relates to Mr. X, whose first accounting period was for 4 months, ending 31st January 2017. Thereafter, Mr. X prepared accounts for years ending 31st January. In other words, these were now full years ending 31st January. The tax-adjusted profits for the first 4 years were as follows. 4 months ending 31st January, 36,200. 12 months ending 31st January 2018, 65,450. 12 months ending 31st January 2019, 82,700. 12 months ending 31st January, 94,530. Now, in this scenario, the taxable amounts in each of the relevant years is as shown below. Now, if you look at looking at the basis periods and the profits and in which tax year they will be charged and on what basis, this is what we see. The first 4 months, which go up to 31st January of 36,200, will obviously be charged in 2016 on a preceding year basis. Why do we say this? 31st January 2017 as end of that period gives us a year ending of 2017. So because this is going to be on a preceding year basis, it will be taxed in 2016. And it follows again that the next 12 months to 31st January 2018, which clearly falls in year 2018, is going to be taxed in 2017 on the preceding year basis, because we said any accounting period that ends anywhere between 1st of January and 31st March, it will be preceding year basis. And this applies also to the last period, which ends 31st January 2019 of 82,700, which we are saying it will be on preceding year basis. Therefore, if it is a 2019 profit, then it will be taxed in 2018, which is the previous year. Now, this then leads us to another example on the commencement rules. The first accounting period of Mr. X again was for this time around for 15 months, not 4 months, but 15 months, ending 31st July 2017. Thereafter, Mr. X prepared accounts for years ending 31st July, 12 months, 12 months. The tax-adjusted profits for the first 4 years were as follows. We are given the 15 months there, 100,360, up to 31st July 2017. Then the next 12 months, up to 31st July, 75,450. The next 12 months ending 31st July 2019, 92,100. And then the next 12 months ending 31st July 2020, 97,220. Now, in this scenario, the taxable amounts in each of the relevant tax years will be as shown, where we show the basis period, the profit, the tax year in which it's set, and then the basis period. Now, you see, all these periods here are ending 31st July 2016, meaning that this accords with the current year basis, where we said any company whose profits ends anywhere between 1st of July to 1st of April to 31st December, the basis will be current year basis. So the 3 months to 31st July will be taxed in 2016 because these profits fall in the year 2016, therefore they'll be charged in the same year 2016. And this applies to all the other months that fall. And this was done after we split the first 15 months into two components, one having less than 12 months and the other one having 12 months.
Whether you're laying down foundations for your business or restructuring market goals, it's important to have professionals that you can trust. Chartered accountants are key to business growth to help you bring your ventures to the world. That's why you should make sure you have a CA Zambia on board. CA Zambia is a globally recognized chartered accountancy qualification that ensures our chartered accountants uphold international standards and stay informed on the best accounting practices worldwide. Keep your business growth healthy. Go with a CA Zambia certified accountant. CA Zambia, developing business leaders.
This takes us to cessation rules. When we talk of cessation rules here, we are looking at a case where a company ceases to operate. And then we're saying, how are you going to tax its profits? The rules are that if the last accounting period is of less than 12 months, the profits of that period will be assessed in the period following the one that had 12 months. And if the last accounting period is of exactly 12 months, then the normal current or preceding year basis will apply. Again, we are saying it will depend whether the end of the accounting period is between 1st of January and 31st March, or it is ending between 1st of April and 31st December. And then if the last accounting period is of more than 12 months, such a period is broken down into two periods. The first one having 12 months and the second one having less than 12 months. This is the opposite of what was happening when you are looking at commencement rules. Here, the first one will have 12 months and the second one will have less than 12 months. Now, the period which will be having 12 months is going to be assessed using the normal rules, meaning either current year basis or preceding year basis, depending on the end of the accounting period. And then the period having less than 12 months will be assessed in the tax year following the period which had 12 months. Those are the cessation rules. Now, the other difficult area in this syllabus comes in when you look at the employment tax. Candidates normally here are unable to consider the number of months which an employee will have worked in a tax year, and this becomes a critical issue. For example, if I worked only for 9 months and I'm entitled to a salary of, say, 12,000 per annum, it would not be proper for you to be showing 12,000 as what I earned because I only worked for 9 months. Split that into, give it me a salary for 9 months and tax me on that because that's what I will have received. Now, when it comes to the next difficulty is on capital allowances computations. I think for a long time now, when a capital allowance question comes in with a few complications, most of the students, they've got a problem in coming up with the right answer. And this is because most of the candidates will not be appreciating that calculation of capital allowances is always on cost. And this will be done using capital allowances rates, which will be given in the question paper anyway. And then the second problem is that they will not be able to appreciate that calculation of capital allowances is limited by the amount of income tax return value that is available. In other words, if you got an asset which is costing 20,000 and you have enjoyed capital allowances of 10,000 already, there's no way that you can come back later and claim 15 because that will be more than what you're entitled to. So that's the other limitation that comes in. The other problem is that of claimable capital allowances being subjected to private use adjustment when it comes to an incorporated business. Now, what it means is this. If you got an asset which is capable of private use, in a case where the company is not incorporated, in other words, it's not a company, a limited company, you will have to adjust the capital allowances that you're going to claim by removing the private use aspect. The other aspect that becomes a problem here is where you sell an asset and then the disposal proceeds are taken into account wrongly. Because you see, disposal proceeds of an asset that is disposed of is limited to the original cost. In other words, if you're going to put a disposal proceeds of, say, 35,000 kwacha, when the original cost was only 20,000, that would be wrong. You needed to put a 20,000 as the money that you got in selling the asset. And the next problem that we get most of the time is how the capital allowances are actually computed. And in this regard, I'm suggesting to us today that we come up with a capital allowances computation schedule that takes into account all these handicap areas that we've looked at. So let's look at a case here where it is suggested a capital allowances schedule should be constructed so as to accommodate all possible eventualities by incorporating the following elements. 1, you need to indicate the date of purchase of the asset. And this will assist you in determining whether there's any ITV coming from previous years or in fact there's no ITV to worry about. Secondly, you need a description of the asset. You see, it is the type of asset that is entitled to a particular rate. So if you don't describe an asset properly, you will not be able to come up with a proper rate from your tax tables, which are normally provided in the exam anyway. And then the capital allowances rates, as I'm just saying, they will be given to you. So it's a question of picking the capital allowance rates which suits the description of the asset that you got in front of you. And because these capital allowances are always calculated on cost, the next item that you must show on your capital allowances computation schedule is the cost. And then, of course, if this asset was bought sometime backwards, you need to show the amount of income tax value that is still available to you, if there's any. Because you see, if there's no ITV brought forward, it means that you can no longer claim any capital allowances on this particular asset. We must also note that the disposal proceeds, as I said earlier, will be restricted to the original cost. And then we are saying, when it comes to capital allowances and charges, which will be restricted to business use, will have to be put in one column. And lastly, any ITV being carried forward will be shown. Now we are saying this, we're saying, okay, let's look at a simple example of a case where in the tax year 2019, Company X has the following non-current assets transactions. I'm showing here the asset itself, the date of purchase, the cost, and disposal proceeds. The first item we got there is a motor car which was purchased on the 5th of 10, 2017 at a cost of 35,000. And then it got disposed of for 40,000 in 2019. The next one is furniture, which was bought in 2018 for 5,000. Motor van purchased in April 2019, 65,000. Industrial buildings, which were purchased 25th February 2016, some years back, at 275,000. Now we are saying, in this scenario, how can we present this in a more user-friendly capital allowances computation schedule so that we don't get lost at all? So we said we want the debt, as you can see, and we would like also to show the asset. We want to show the capital allowances rate, the cost itself, the ITV brought forward, disposal proceeds, if any, capital allowances which we are claiming, or charges against that, and then the ITV which is being carried forward. So you will note that for the building, which was bought on 25th February 16, the capital allowances rate there is 5%. You will note that when it comes to industrial buildings, in the year of actual purchase, you're entitled to an initial allowance and an investment allowance, both of them 10% each. And over and above that, you get a writing down allowance of 5%. This writing down allowance continues from the second year onwards until the asset is completely written off, so to say, in tax manner. The next item here shows that the cost of this was 275, and ITV brought forward was 178, which means that the difference between the two is the capital allowance that you've already enjoyed. So you are still yet to enjoy 178,750 capital allowances. Therefore, you go ahead and calculate 5% of your 275,000 to get 18,750, and that will leave you now an ITV to carry forward of 165,000. Now, if you look at the next item there, which is a motor vehicle which was bought in 2017, we know that a motor vehicle which is private, which is capable of private use, the capital allowances rate, which will be showing in the tax tables, is 20%. And this is always calculated on cost. Now we see that this motor vehicle was actually sold at a value more than the cost of 35,000, which was 40,000. So we are saying for the purposes of this schedule here, you are only going to show a disposal proceed of 35,000, although what you actually received was 40,000. So this will leave you a balancing charge of 14,000. Balancing charge simply means the disposal proceed minus the ITV that you are still able to claim. Now, when you look at the furniture there, we're saying, okay, it was bought in 2018. Because it is furniture, we know from the tax tables, which will be provided to you, as I am saying, it will be 25% that you can claim on that. And it will be on cost. And the cost is 5,000. So you calculate 5,000, which is 25% of that, which is 1,250. You are able to claim that because you still got 3,750. So when you claim your 1,250 this year, it means you still got another 2 installments to claim 2 years to come. And lastly, when you look at a motor van which was bought in 2019, which is the same year, you are entitled 25% capital allowances at the cost of 65,000. And that works out to be 16,250. You will note that here the ITV and the cost is the same because you have not claimed anything. You have just started. So your ITV becomes 48,750. So when you go to next year, 2020, the ITV that you will be showing will be 48,750, not 65,000. So this is, in a nutshell, a sort of proposed capital allowances computation stage, which we feel that can help us a lot in minimizing time in our exams. Now, this takes us to business profit computations. Now, you see, the problem with business profit computations is mainly due to adjustments which are not done properly, and also capital allowances computation that comes in, which would be on a similar note to what I've alluded to earlier when we were discussing capital allowances. And then also how to treat investment income, given that it can be said to be gross or net. And then also premiums on rental income. Now, having said that, it is suggested that when you do your business profit computations, do the adjustments side by side, meaning that as you go through the question, if the adjustment in front of you is something that you must add, put it in the add column. If it's something that is supposed to be a deduction, put it in the minus column. This will minimize time at the end of the day, as opposed to you first concentrating on the items that you must add. Then later on, going through the same information to see the items that you must subtract, wasting time in exams. So please, let's have the adjustments done side by side. This takes me to the suggested general examination technique. It is important for candidates to read the requirements a number of times slowly and carefully and highlight the key verbs such as explain, list, state, define, describe, distinguish, calculate, and so on. For example, candidates may have difficulty to differentiate between describe and explain. An explanation is a set of statements constructed to describe a set of facts which clarifies the cause, context, and consequences of those facts, while to describe is to communicate the key features of something. So you see, The key verbs in your exams are very crucial because that will hinge a lot on the caliber of the answers that you're going to come up with. Now, secondly, plan your answer, because an answer based on a plan will be better than the one that is not based on a plan. In other words, when you are answering, you read through your questions. It is better to start with the question that you think is the cheapest in the exam and then proceed to handle the others. And number 3, can you please use the subheadings based on your answer plan? You see, this will be beneficial when you're answering theoretical questions. Don't just hide your ideas in a paragraph. Sort of highlight the main thing that you're talking about so that you can attract the attention of the marker so that you can easily get your marks. Fourthly, as we said, you can start any question as long as numbering is clear, and ensure that you tick the questions attempted in front of your answer booklet. When it comes to this, we are saying if each question that you're going to attempt, please can you start it on a brand new page? We don't want a case where on the same page you got the part of question 3 and then you got the question 4 also starting. Please, when you're going to question 4, go to the next page. A new brand question answered on a brand new page, and so on. And we said, okay, that is said, answer on a new page, but it's not mandatory, but please, it helps us in the long run. When it comes to numerical questions, the following guidelines should be observed. Where possible, use the standard workings. Like you could use a table, like I've suggested here, a table that you can use to present your capital allowances computations in the interest of time and clarity as well. And also show your workings to support your main answer if there are any. Verify your computations for accuracy. But you see, verification here can only be done if you got ample time at the end of the day. But do the best in the first instance. And keep moving on. Don't spend too much time on one question. Please, allocate time to each question depending on the marks that are available. If you got a question that is for 25 marks, you know that roughly you must spend about 45 minutes on that. Keep watch on your time. 45 minutes has elapsed. Please move on. Go to the next question. Manage your time. This is what I'm talking about. This marks the end of this presentation, and I hope that we will have better results in the future. Thank you for attending.